Okay, so we started the sources of business finance last week, and I think we did quite a lot around that topic. So I think I'll give Prof. Cyril and Prof. Deladem the opportunity to quickly review the things that we did last week on sources of business finance. So Prof. Cyril and Prof. Deladem, the ball is in your court. What did we discuss about sources of business finance? Okay, C before D, right? Cyril, C before D. So Prof. Cyril, I think you take the lead. Yeah.
Okay, so we learned about the sources of finance,
Okay.
which is the bank loan, trade credit, bank overdraft, and so more. And we also learned that we have short-term finance and then long-term finance.
Okay.
Yes.
Okay. Thank you very much. Prof. Deladem, what would you add up?
Okay, so we define the sources of funds as the various avenues or means through which a business can raise the necessary funds to pay. Also, we classify the sources of business finance. The first one was repayment period or the duration during which it takes. So under the repayments, you said we have short term, medium term, and long term, but you said the medium term is not really necessary. So yeah, and then the second one was original source of fund. Yes, please. And the rest zero said
Okay. Okay.
so.
Okay. Great. So thank you very much, professors. I really appreciate it. So, Prof. Charles, as a way of inducting you into the class, these are a few things we discussed last week, as briefly explained by your colleagues. So, we looked at the sources of finance or sources of business finance, and we defined it. And we said that sources of finance refers to the various means or avenues through which businesses raise funds or resources, right, to support their operations. What is important is for us to look at the classification of these sources of funds. So we said it can be classified based on the payment duration. So we have short term, medium term, long term. Now let me add the specific definitions of short term, medium term, and long term so that we can appreciate that going forward. So a short term finance is one that is due for repayment within 1 year, or the period is less than a year, right? So maximum 1 year, you should have settled such a facility, right? And then the medium term ranges between 1 year to 5 years, okay? 1 year to 5 years. And the long term is from 5 years and above, right? So let's get that in perspective. But in terms of realistic examples of medium term, you normally see the medium being attached to, so maybe medium loan, bank loan, right? So we will not pay much attention into the medium term. The focus will be on the short term and the long term. Okay. So I think we picked the short term, and as we have indicated, these sources of finances are expected to be repaid within 1 year or not beyond 1 year. So the examples we saw were trade credit, hire purchase, loans from friends and relatives, loans from money loan lenders, okay, short-term bank loans, and then bank overdraft. So these are the few sources we looked at. But I think we threw more light on the trade credit and the hire purchase because there were some technicalities in there. So again, I think Prof. Edem is here now, so I'll call on Prof. Edem to give us some of the technicalities when it comes to trade credits and hire purchase. So Prof. Edem, let's hear you. You are welcome anyways.
Okay, so okay, um, so trade credit, as
Okay.
you said earlier, is a short term financing. Yeah, so this is when the business and then the lenders, or I should say the creditors, like make an agreement that the business would like purchase the goods and then repay it later, like within a few months.
Okay.
And then hire purchase was when the the business, right, agrees to purchase an asset, example, and then they they make full payments before the asset is handed over to them.
Okay. Okay. So I think yes, he puts in some of the technicalities in there. So we said trade credit is normally used in an arrangement where a business would see a supplier, get the goods from the supplier, agree to pay within some days or months, right? So what actually happens is that the business will take ownership of the goods, go and sell them, get the money or generate the income, and come and pay off or settle um, the liability, right? But most of the times it comes with an interest. So you find people saying if you pay cash promptly, this is how much you are going to pay. For example, 1,000. But if you say you pay me at the end of the month, then you pay 1,200. So there's that interest component in there. Okay. But what was significant was that ownership of the goods are transferred to the business or the buyer, right? That was not the case for hire purchase. For hire purchase, we said it is an arrangement where the business acquires an asset from the seller or the supplier, right? And makes an initial deposit and pay regular installment, right, for a specific period of time. And ownership is only transferred at the time you finish payment on the hire purchase. You have the option to own the asset only when the hire purchase agreement has been reached. Okay. So unlike the trade credits, for hire purchase, you'd have to finish paying before. And so we said it is more convenient in acquiring fixed assets. Okay, you can use hire purchase for perishable items. And I give a specific example. You can't go and purchase somebody's pepper on hire purchase. No. But you can do so on trade credit. So trade credit could be for perishable and non-perishable. So fixed asset or non-fixed asset. Okay, so thank you very much. So today we are moving on. I think I spoke about the loans from friends. We all know, right? You take a loan from your friend or loans from money lenders. The popular ones in town, I think, is Fido Credit and Bills. Yeah, you can take money from them for businesses, but all these facilities come with some interest. Then the bank overdraft, I think I hinted that it is a facility that is given on current account. So let's take note of that. You see, when you go to the bank, you have the option of opening a savings account or a current account, or sometimes a fixed deposit account. The current account is that type of bank account where you have unlimited opportunity to transact business. Okay, you can withdraw as many times as you want. You can deposit as many times as you want. Okay, I think the deposit doesn't even count, because with savings, you can also deposit as many times as you want. But the withdrawal, savings account, you cannot withdraw anyhow, right? But current account, within a day, you can withdraw as many as you want, right? So this facility is given for this type of account because current account operators also see a lot of transactions on their account. Every day money is being deposited, so the account is very, should I say, very active, right? So the banks, knowing that money flows into such an account, give this facility called bank overdraft, where the account holders can withdraw more than what they have in their bank account. Okay, the idea is that definitely money will be deposited into their account, so it will be set off with some little interest. Those of us working in the public sector, those taking salary from the government, we sometimes go into these arrangements where we know salary will come around 25th, but we need money now. So we take money now, okay, in the form of a bank overdraft. And then when our salary hits the account, the bank deducts with a little interest. So that's a bank overdraft. It's a short-term loan facility granted to current account holders, okay, allowing them to withdraw more than what they have in their bank account. Okay, great. So let's continue with the long-term sources, right? So as I indicated, they are expected to be paid beyond 1 year, specifically 5 years and above, right? Beyond, so let me be specific with that, beyond 5 years. So between 1 and 5 years is the medium term, right? Okay, so I asked you to read a little about the long-term sources. How many of us read? And if you did, can you share what you read about the long term? So, Prof. Charles, I hope you are not missing. At least you appreciate what we've discussed so far. Okay. So, long-term sources of, in fact, in this country, what type of loan can you take and you are expected to pay 5 years and above? Prof. Deladem, did you read anything about it?
So I think long-term bank loan.
Okay, so we have the bank loans, the long-term bank loans. That is very true. There are some bank loans you can even pay up to 7, 5, 10 years, right? So we have the long-term bank loan. Okay, so let me write the first point. Long-term bank loans. Okay, what other fixed or long-term sources can we look at? Okay, is that Prof. Cyril? Yeah, Prof. Cyril, let me hear you.
Say leasing.
Leasing, okay. So let's get all the points and then we'll pick and explain them one after the other. Leasing, okay. What else? I think I'll add one, mortgage loans or mortgage, right? Mortgage loans. I think we have debenture, what a friend of mine calls debenture. Debenture, right? And then we also have shares. Okay, so we have 5 now. So apart from the long-term bank loans, I think we need to appreciate the leasing, the mortgage, the venture, and then the shares. So let's pick the leasing. So Prof. Cyril, you brought in this big word, oh, me, I don't understand. So help us understand. Leasing, what does it mean? Leasing, to lease.
Okay, so it's when like someone agrees to like use an asset for a long period of time. Example, like equipment, like machines, vehicles,
Okay.
for a long period of time, like without owning it.
Okay. Okay. That's true. That's true. So I think along the line we'll be comparing with the other sources, try to know the differences between the two. So if you are leasing is used in the acquisition of assets again. Of course, you can't go and lease onions or pepper or tomatoes. No, it's not possible, right? So leasing is a financial arrangement. So let me write. It's a financial arrangement in which one party called the lessee. So we are picking some terms here. The lessee uses the assets, or let me say the property of another party called the lessor in exchange for regular payments over a specific period of time. So let's digest this English. So it's an arrangement, right? Or it's a contract where one party called the lessee, so let's note this party, lessee, uses the property of another party called the lessor in exchange for regular payment over a specific period of time. Okay? So an example is for Mr. Amwa, I may have a laptop and Prof. Charles may see me to agree with me that, oh, Mr. Amwa, please, I want to use your laptop so that every month I'll pay you 10 cedis, right? So that arrangement is an example of what leasing. So he's going to use my asset, which is the laptop, and will make regular payment over a period of time. Now, the owner of the asset is the lessor, right? And the person who is going to use the asset is the lessee, right? Or lessee, if I should say it like that. So there is that regular payment that the person has to pay to the lessor. Please, do we appreciate that? So I think we have been hearing this. So he has gone to lease a land or lease a house, right? So even in our various communities, we hear of this, right? We lease people's buildings, and normally the amount paid there is called rent. Okay, rent or lease payment. So when you are using somebody's building and you pay the person every month rent, that is a typical leasing arrangement. Now, if you are not careful, you might think it's the same as hire purchase. But the difference is that with hire purchase, you make an initial deposit. Okay. You make an initial deposit and then the remaining amount is spread over a specific period for you. Okay. Now, there are types of leases, but I don't think we would have to look at these types of lease. But for the purposes of further learning, let me say a few, right? So we have an operating lease and then a finance lease. Okay. So the operating lease is one where the person using the assets, right, is going to use it for a specific period of time. So when that time expires, the agreement also ceases, right? So it is cancelable. Operating leases are cancelable. But the other one, which is finance lease, that one is often non-cancelable. Okay, so the person using the asset even goes ahead to bear all the risk and rewards of the ownership of the asset. Okay, but that is just for further learning, right? Now, another important thing here is that if you are leasing somebody's asset, you cannot use it as a guarantee for any credit or security for any loan. So a typical example, if you are renting somebody's room, you cannot go and use that room as a security to take a loan from a bank, okay? Or as a guarantee for anything. You can't do that because you don't own the asset. Okay. Please, any questions? Any questions? Are we okay? Any questions? Della, them, Charles, Adam? Questions on the leads?
Sir, please.
Mm-hmm.
Sir, please, are the rentals on the lease fixed or something?
Yes, it is fixed. So I don't know if you have rented a room before, or should I say an apartment before. It's fixed. But depending on the arrangement you may have with the landlord or the lessor, sometimes after the agreement expires, if you want to renegotiate again, that's where the increment comes in. So let me give an example. If you go for a chamber and hall right now, and the person says, oh, it is 100 cedis a month, right? So it means that it won't change 100 cedis until maybe you say, okay, then I'm renting it for 2 years. Until that 2 years expires, the person cannot come and say, oh, please, I said 100, but I've changed my mind, it's 200. No, the person can only do the increment when the first agreement has expired and probably you want another arrangement. Okay. So you see that most landlords or landladies will tell you, when your time is up, I'll increase it, right? They don't increase it when you have agreed already. They do the increment after the first agreement has expired. So yes, the amount is fixed. If it's 100 cedis a month, 100 cedis. But in real terms, I think what we do is that we accumulate and pay in advance. So 2 years advance, we do the calculation, 100 cedis a month, 2 years, that will be 2,400. Then we pay the landlord or the landlady. But in the real contract, it is that regular payment. So 1 month, 1 month, 1 month. So the amount is fixed, yes. Okay, thank you for that question. So I think we'll look at the second one, which is the mortgage. Mortgage. So professors, the first session is up. Let's meet in the second session and continue with the mortgage. Thank you. So please go to the page and pick the second session details. So see you soon.